So we are kicking it off here. We're just a couple of minutes in. So the intent would be more to share some really good ideas. And one of the things that I talked specifically to Andrew Cardwell about yesterday was we talked about this RSI trend line on the top of the S&P 500. And so I'm not going to cover that off with you today. I will let him do that. But this is a monthly chart. And the big thing always to be aware of when you're looking at monthly charts is they take out all the wiggles and they kind of give you the big picture. But the problem with that big picture, many times it'll take a long time to kind of play out. And so I have down at the bottom here, I've got a trend line that was rising in terms of momentum. And now what we see is that trend line is starting to fail. And more importantly, we have a big trend line up at the top here that's like a 20-year momentum trend line, and we keep making lower highs on that. So that's a little bit frustrating. And somebody said, make sure you are recording. And I'm pretty sure I am. So I just need to, it's got the recording flashing light going. So I'm okay there. So thank you for that. Okay, so anyway, so the bottom line is we've had this momentum trend. So this is 2009 down here. We ran up, we had a nice big rally, and we kind of peaked out in 2014. And you might remember 2013 and 2014 were the unlimited QE event. And so I always have trouble with that timing because the problem on unlimited QE obviously is it was literally a money pump that was coming straight into the market. And almost all of the indicators just went flat. They literally did not have any sort of wave anymore. As things went up, we just kept having this big muted sideways or smooth price action with absolutely low volatility, and through 2013, and then in 2014 it ended, and we kind of topped out in March. In terms of momentum, and then in May is when the market finally topped out. So we were making, significantly lower highs in terms of momentum on a monthly chart, but again, the chart was still going up. All that to say, here we have the same situation. We have basically unlimited QE from every government in the world, or unlimited monetary policy from every government in the world. And from the feds, what we've got is unlimited QE. So we're getting it from both sides of the fence. We're getting it at a civic level, at a provincial or state level, and we're getting it at a federal level. You can't get much more candy being delivered to the market. So I don't want to be a bear until the charts kind of force me into that position. And again, I still think that there's just so much stimulus that, we're still waiting for the White House and Congress to kind of settle out on another stimulus bill for the U.S., but it's not just the U.S., it's the rest of the world, and we have to watch the charts. And at the end of September, when I did my monthly review, it was all about the charts. And again, my big focus for that was looking specifically at the rest of the world. And one of the things that we noticed was a lot of the world had weak charts, and that weakness is what we're worried about. So I want to make sure that when you come away today, you get a feel for the big picture. And again, we'll have some really timely stuff that'll help you on a smaller time frame as well. So again, we're worried about this big downward trend in momentum. And as you can see, we're just getting to that peak right now. Briefly, we rolled over and we broke this upsloping trend line. So if we were to start rolling over now from a monthly chart, big bearish implication, it's definitely there. So again, I want to be bullish because I have like 90% of the NASDAQ stocks above their 200-day moving average, the NASDAQ 100. And typically that's very bullish. But I will say in the last 2 weeks, that number changed by almost 20%. So that means they're very close to their 200-day moving average. And if they were to start dropping away right away, that would probably be a clue that we have more to look at. So I want to be optimistic. I want to make that very clear. Okay. Anyway, so thank you everybody for coming. We just kind of opened with a monthly chart for all those that are just arriving, and I want to welcome you to the Canadian Technician Day. We've got some great speakers again. I've got Andrew Cardwell coming up, who did a lot of work on the RSI, and he used to actually hand plot the RSI and hand calculate everything before the days of computers. So I'll call it very familiar or intimately familiar with the RSI. And so I am very much looking forward to that presentation. Dwight will have a lot more short-term stuff, all of the positive different charts that we're seeing. And, I think some of the things we were talking about this week was it was like shooting fish in a barrel as we come out of this rally. Everything's trying to go higher and things look very positive. From Barry Powley, he's going to present some of the things he's seeing on the charts, and Barry's got a CFA background, so he's also able to incorporate some stuff that I don't typically incorporate. So I'm looking forward to that wider view. And then Tom McClellan is going to come on, and Tom's got a couple of things he's going to share with us. And Sherman and Marion McClellan they built the McClellan oscillator as well as the summation index. And those two things are a regular viewpoint for me. I look at those every week when I go through my work. And the one thing that Tom is going to share with us is just, what he's seeing through the advanced decline data. So I'm not going to cover that off today. I'll let Tom go through that. But I do want him to go through some of his cycle work. So we're going to try and get some of that from him. And that'll help wrap the big picture that we get from Andrew, from Dwight, from Barry, from Greg, and lastly, Tom. So when we work through these 5 different presentations, hopefully by the end of the day, you have a really compelling situation for you to kind of view, or a compelling prism to view the market. Okay, I'm going to close the chat window here just because it makes it a little easier for me to see everything on the screen. It looks like everybody's logged in now. So if more come in, I'll try and jump over and let them in. But the one thing I want to say here is the reason that we need to be so sensitive is that we are looking at the S&P 500. So we had the big push up, let's call it from October in 2019, and we ran up really, really well. And then we kind of had this COVID wave right in here where we heard about it, then we pulled back, and then we took off again. And we kept trying to go. But on this particular rally, we had a lot less momentum. That's not easily seen on the weekly chart, but when we go to the daily, it is. And you'll see on the RSI, it made a lower high, while this made a higher high. What we see over here is we've got a rally. And on this rally, when I wave over here, I'm letting people into the room. So just so you know, it's not that I'm trying to drive you crazy with my cursor. So we broke out to new highs, right? Really nice push for a week, and then we made a higher high, and then we reversed. And this was a big outside bar and pulls down. Now, one of the things about an outside bar is it means we tested higher, tested lower, and then where did we close? Well, in this case, we closed it near the lower half of the bar, or in the lower half of the bar, and then we dropped for 3 or 4 weeks. We came down to the 20-week moving average, and rallied out of that hole and came back up. And in the last 2 weeks, we've basically tested that closing high. So if this is a line chart, which I think my next chart is, we're basically sitting right up around the top of that. I'm going to go back to the bar chart, and the reason I want to show that is because of the price action this week. So we opened higher, that was nice. We pushed up, tested higher, pushed lower, tested lower, and then we rallied and we put in a slightly higher high, like we closed up 0.2% on the week. And in general, we're just testing this 3,500. Now, one of the uncomfortable parts of where we're stalling is the fact that we're stalling near an old high. So first rule of technical analysis is when you're near an old high, you want to make sure that you have the power to get through it. And the big thing that we need to be aware of is on that big picture that I just showed on the monthly chart, we had a lower wave of momentum. Well, now we would have a lower wave here, and you can see we topped out in August, pulled down, and now we bounce off our signal line. And then if we start to fail, that's really not that comfortable. And one of the reasons that it would be more daunting is we've put in a really high level of momentum. Not to say that the market is overbought, but it's very enthusiastic. And again, we have lots of reasons for that. We have lots of government stimulus. We have an economy that is improving, albeit from a low level, but we still have some situations that need to work out. Now, one of the big things that happened this week that I thought was extremely bullish, and then the market failed to respond, was JP Morgan's earnings. So JP Morgan, obviously one of the bigger banks, came out and they literally blew away numbers. I think they were 30 or 40% better than expected. And so you have this big earnings push above, and yet you got no response from the market. And all through the week, we just didn't really go higher. So we're testing the prior high. We have great news come out and we can't make anything out of it. That is uncomfortable. And again, we're all worried about the banks. So if the banks aren't going anywhere, how can the rest of the market? And obviously, we've had the tech sector rally for a long time, but I'm going to talk about that specifically as well. The tech sector is a really important component. Obviously, they make up almost 30% of the S&P 500 now. I think it's 28 or something. So as we keep rolling here, we want to be very focused on this prior high. So what happens is you test your prior high, you pull back, and now when you get up here, you might wobble a bit and then take back off again. That's what we want to see. What we don't want to see is, again, this big slump where we come along and then we fall apart. Now, as you could see back in 2019, we had multiple waves here, and it just took a few weeks to kind of work through. And, maybe we either get a vaccine that all of a sudden pops the market and gives us some enthusiasm, or we get a stimulus package that gives us another couple of weeks or a month of enthusiasm. That's what probably the market's on hold for. But the real question is, do we have the energy? And the problem I had when I went through my charts this week was literally all of the big bullish things I liked all stalled. And that was a real problem for me. Okay, so I'm going to quickly cover off the NASDAQ here. So again, we had this big outside bar, same thing, we come up and test. Now the NASDAQ wasn't quite as good as the S&P 500. It closed pretty much in the lower quarter of the bar. So what that means is we tested higher and fell back down and basically closed right near the lows. So there wasn't a lot of enthusiasm for going higher. Now we're going to go look at some of the charts within the NASDAQ, and those charts would be the big caps that we need to see. And those big caps, again, are they're very representative of the index, but they're also representative of risk on. And so while they carry the majority of weight, because the index is basically the multiplier based on the size of the company, those larger companies carry more weight in the index. What we don't have is a smooth representation from the small caps. So we wanted to just see that. Well, guess what? Last week, the small caps took off and they looked like they were going to join the party. And then this week, they just kind of went, they had nothing. So here's your NASDAQ monthly chart. We're tucked up in the right-hand corner. We're basically at this momentum trend line. We were a little above it, and I really like that. And again, you can see since 2010, we've stayed above it. Even the COVID low here was no big deal. And we rallied up, and now the real question is, can we keep going, or are we just so high at such a big extreme that all of a sudden this is all going to roll over? And that's probably more what I'm worried about is we're at such a big extreme, everybody's all in. Who's our next buyer? So let's go take, I'm just going to go get some chart lists here, Amazon, and let me just go down in here. Again, so I had a whole presentation all ready for today, and we're not going to do that presentation because of the charts. The charts that I go through every week were a lot weaker than I expected and are really driving me crazy. So here's the large caps, and again, there's whatever 7 on this page. We're going to just quickly look at each one of them. So what we see is Amazon back in July made it up to 33.44. Here we sit just below 3,300 3 months later. So to say they've lost their mojo, I would say is fair. We had a sudden surge to start the week, and then we drifted lower all week, and that's just really not that great. Again, we're testing the prior high. So what we have here is a left shoulder ahead, and we don't want to form a right shoulder. Now, the head and shoulder top is widely discussed as this big bearish influence, but the problem really what the right shoulder is you're making a lower high. So you make a left shoulder, a higher high, a higher low, and in this case a similar low, and then we've made a right shoulder so far where we're pulling down. Now we closed above the 50-day moving average, but not by much. Okay, so that's what we're going to look at just on each one of these charts. And the other thing to notice is that a lot of these are breaking their upsloping trend lines. So here's Apple. And again, we just had we had the Apple announcement mid-September for all of their new technology, and that was a relatively muted event. We just had the phone event, and that was relatively muted. On neither one of those could we really rally. So that's uncomfortable. We rallied into it, but not out of it. And then Facebook, we've got this a real important support and resistance layer in around 250 here. And so they rallied all through August. They fell for most of September. And the real problem here is we've come off the low and we're making higher highs and higher lows, but we're back again below that 50-day moving average very, very quickly. It's just not optimal that all of a sudden all of these big names are failing while the indexes are trying to take out the prior high. So here's Google. We got the same thing with a higher high, higher low, higher high, lower low, lower high so far. And it's early again, but what was happening was we were having a nice rally, and then all of a sudden this whole thing stalled, and it was options expiration week. So that's one of the charts I keep track of, is just how did the markets behave after options expiration. So here's Netflix trying to take out prior highs. Looks very bullish. On each one of these, momentum is getting weaker, so that's a problem. When we look at Microsoft, again, higher highs, higher lows, then a lower low, and now a lower high, and that's one of the areas we want to work on. So all of these charts are showing similar kind of lack of momentum to the upside. That doesn't mean we're going to roll over and fall. It just means right now, for some reason, we're losing that gusto. We've got a lot of earnings to get through in the next 1 week or two. And once we get through those earnings, I would expect that we have a much better look at how this is all going to fare. But my uncomfortableness comes from looking at the weekly charts, not just these daily looks here. But here's Disney, and again, it's been trying to hold the 50-day moving average. It's been almost 3 weeks below it. So did, Microsoft up here, a brief rally, and then to give it all back. So again, we rallied Thursday, made a rally up on Monday, and then didn't do anything for the rest of the week. And we see that on almost every one of the charts. Tesla is one of the big charts. I wrote an article on the Canadian Technician, or actually in the Chart Watchers newsletter for stock charts last night. And I talked about how Tesla has started to break its uptrend in momentum. So not this uptrend in price, but in momentum, which is your PPO indicator on the weekly chart. And its parabolic rise compared to the S&P 500 on the relative strength. So when you compare Tesla, so that's this chart here, when you compare Tesla on this daily chart, what you see is price action is moving up and to the right. I'm just going to clean a couple of things off here. Actually, let me just annotate it to show you what I mean. So we have this uptrend, and what we don't want to see is Tesla start to break this one. Well, on a weekly chart, it was parabolic. So you draw an arc, and we've broken through the top of the arc. So it's at least something to be aware of. On the actual price trend here, we see Tesla sitting pretty much right on it. Not a whole bunch of room here to start breaking down. And in the last 2 weeks, there's been no real enthusiasm, even though they came out with announcing, the car goes on a lower price, and the car went on a lower price, and he ended the price number at 420, the old funding secured 420 laugh about. So when we look at the momentum wave, this is the PPO. When we look at the PPO, what we see is we made a high and we pull back, and we make a high and we pull back, and everything's going along and we're working great. The problem here is we've spent almost 6 weeks pulling back, and we've had no real response to the upside. Now, maybe we're just in a pause mode, but I actually think all of the problems we've had with, or sorry, all of the new companies coming in, including the special purpose acquisition companies that have started to join the party. And we've seen Ford come out with new cars, and just about every auto manufacturer. So Daimler just broke out, and that's in that Chart Watchers article about how these other car companies, their charts are starting to shape up. And in the meantime, Tesla's, basically traded in line with the S&P 500 for the last 2 months, hasn't really kind of kept that outrageous rate of growth. It went up tenfold. So if Tesla took some time off, who'd be surprised? Anyway, so looking at these charts, the top tech names here, I think the real problem we have is that we don't have a lot of none of those charts have broken out to new highs, kind of willing to carry the market higher. So that makes me a little more nervous. Okay, let's get back to my other charts. And what I want to get into here is some specific price action. I'm just looking for the chart that I want to show you. Okay, so here's your S&P on a daily basis. And again, one of my little clues in the market, so if you're looking for a tip for today, this is my tip. When you have a PPO above zero and it stays above zero, that's excellent. When it starts to go below zero, one of the things you can watch for, doesn't always happen, but you can watch for, is usually before your final high. So the market's running up, everything's good. Usually before your final high, what will happen is the momentum indicator will actually dip into zero and then fail on the next rally. And so your next rally is either a higher high at the high or a slightly lower high. But it's this momentum actually getting so weak that it goes below zero on the pullbacks and then fails coming out of it. So one of the issues I have right now on this S&P 500 is we see that same thing. I'm going to skip over the NASDAQ chart and come back to it in a second. But the reason I want to show this is here's the XLY. And I wrote this on the chart this morning. It's not like I wrote it 2 weeks ago or whatever. But what you see here is we've pulled back. Now we fail. And we're on each rally, we're making a lower high in momentum. And more importantly, we're capping in around this 2% level. A doctor that we were on the cruise to Alaska with, Vernon Strand, he's a wonderful guy. And Vernon mentioned that one of the things he noticed on his charts was that, as long as your rallies were nice and high and above 2%, you were still in good shape. And I've started to use that 2% a lot. And you can see back here in September, we kind of stalled at that level. No big deal. It was still plenty strong. But what we're doing here is we're making another lower high. So we've got two of them now. And we briefly dipped below zero. So when you combine it with the dip below zero and then can't get back through 2%, that's a bit concerning. Now, when we look at the full stochastic here, so again, the full stochastic basically says, where are we in the trading range of the last whatever period? And in this case, I've used 14 days. So all of this time in here, we're floating right up near the top of the range. And so the full stochastic says, yeah, you're still up in the top of the range for the last 14 days. Yes, you are. And then all of a sudden you start to fall down. And then we spent all our time in the bottom of the range. And it uses a few days of an average, 3 actually, to calculate this. But what you see is we stay below 50 while we're in this bear market. The 1 week bear market or 2 week bear market where the market pulls back. So as we pull back, you can see the full stochastic has trouble getting back above 50. In late September, we get back above 50 and we go on this nice run. And all of a sudden, we're rolling back over and now we're starting to go down again. I would say we're in the area of concern. We don't want to see it continue to fall, but we want to watch for it closely. My concern is that when we compare this with this, so we first of all have a very weak momentum, then we rally back up and can't get any horsepower, and we roll over right away. So that makes it more concerning. Again, we're the first week in terms of the charts stalling, so I don't want to add fear, but I want to say that there's definitely a level of caution that hit my charts this week. Okay, XLC, so the communication sectors. Here's a better example where we rally up, we fall below zero, and on the next rally, we're barely above zero. We're already down to the 50% level. And again, as long as you stay above 50%, usually you're in a bullish trend. And when you fall below that, that makes it more bearish. So the fact that we could do nothing all week, so we gapped up on Monday, and it's a good thing we did because we didn't do anything for the rest of the week. We were sideways Tuesday, down Wednesday, down Thursday, and a brief rally on Friday that, we opened higher and closed lower, basically suggesting no real power. Looking at XLK, so we had the same issue here. And again, technology's been the leader, right? So we've got this upsloping relative strength trend line. We briefly broke through it here, just kind of nicked down through it and then took back off. But when technology is continuing to outperform, we're usually in a pretty good place. What I find is this trend line starts to crack and break as technology starts to underperform, and that gives us a clue that there's something changing in the rally. So what I need to be focused on here is just making sure that these, that the stall we had this week becomes no big deal and we continue to turn back up and get going again. I don't think we really want to see all these groups start to roll back over. And if you think about the 4 different seasons of the market, we have spring where you're coming off a low and you're below zero, and that's pretty rough trading. Actually, it's very sloppy and choppy. And then you get above zero and the momentum curve stays above, so you're rising. We call that the summer period. This is from Martin Pring's work. The summer period where it's rising, and then in the fall, what happens is you're going down but you're still above zero. And then in the winter position, you're going down and you're below zero. So what we don't want to see happen here is we get below zero and all of a sudden it falls. Because one of the things that we do find is it falls relatively quickly when the PPO goes below zero. So that's what we don't want to see. We don't want to see a downside acceleration right here, right now, because we're testing that prior high and we're doing it on a lot of charts. Okay, industrials looks a little better, right? It bounced down here and it's still trying to go. At this point, we still have a series of lower highs, so that's a little bit concerning, but we had some good news out of Boeing this week and out of Europe accepting Boeing's new 737 MAX work. So that's a potential positive for the industrials. Materials were up on Friday. They looked okay. I will say we're still testing a prior high, so that's always a concern. And again, potential for the rally to top out. Now we had nice volume come in on some of these areas, but let's look at energy. I was all comfortable that energy was starting to break the downtrend and actually starting to work its way higher. Heck no, the full stochastic stalled before even getting into 80 and is starting to roll down again. So perhaps all of the good things going on in energy are all going to start to fail. And one of the reasons to keep that in mind is I think energy is getting better, but it might take till the end of December to get better. So the real question is, if energy is leading us to the downside, that probably means that global manufacturing and global consumption is turning lower again. And if that's going down, that probably tells us the economy is going to slow too much. So on Friday, we got some news that the manufacturing sector in September had turned down instead of continuing to improve in September. So that was a little worrisome, and that might add a little pressure to everything. Here's XLP, the consumer staples. And again, we're trying to break out to new highs. Now, XLP doesn't really outperform the S&P 500 very often. And even when it does, it's relative strength usually. So what happens is when XLP is outperforming the S&P 500, it usually means they're both dropping and XLP is not dropping as fast. Okay, and that's consumer staples. So healthcare is one of the things trying to hold up here. And with a big downtrend in momentum that's starting to break and work its way higher, I like that. That looks really good to me. Again, we broke above a prior high. Not many charts have done that. We've pulled back down. We're bouncing off all my support levels here, and we're starting to take back off. There's a whole bunch of work in the vaccine area, but it's really one of those 10% of the companies are going to make it and the other 10% aren't. So it's a pretty important headwind. Now here's utilities. And one of the things that I think is going on with utilities is it's really conventional electricity that has started to push higher. And that might be on the back of all of these charging stations going in. So again, New York wants to put some in. California was having brownouts, yet they're pushing everybody to electric cars. On my Twitter feed this morning was a picture of a car charger set up, and then right behind it was a diesel generator powering the electric car or powering the charging station. So really need to look at exactly where the strength is. And I think the strength is going into these electric utilities, not so much into all utilities. Some of them renewable. But, here's California pushing everybody into electric cars, and yet they can't keep the lights turned on as it is with their power grid. So really an odd situation. For the financials, you can see, this was the response. Again, JP Morgan reported on Tuesday, and here was the response. So not much happening. Now, we closed pretty much in this range for most of the week. So that's a more important level to be aware of, is that we didn't really fall down. I guess we fell down from Friday's close, but call it flat to down. Again, the bigger issue here is the momentum wave went below zero, rallied back up, and doesn't seem to have any momentum, and we're falling back below on the full stochastic already. So starting to just continually, we see over and over that the charts are getting weaker and weaker. And what I was hoping for, obviously, was a sudden thrush. And we seemed to get that last week, right? We had a nice big bullish run going last week. It looked like we were going to blow through everything, and then we literally got up there and stalled. Now, here's the real estate, and I can't figure out why this one's rallying at all. I realize home building and that kind of stuff is doing okay, but commercial is a little difficult. Anyway, so XLRE, the real estate group, is continuing to hit the prior highs, but hasn't been able to break out yet either. Its momentum hasn't been much for the last 3 or 4 months anyway, so it's not really an area I want to look at, but I am surprised that it hasn't been able to I thought it would be as weak as energy. I'm surprised it's not. And here's that June 8th high, and that just continues to be resistance for everything. So that's one of the concerns out there. Now, I mentioned I was going to skip over the NASDAQ chart, so I'm going to go back and find that. So here's the NASDAQ over the last couple of months, and you can see this big uptrend. And then we had that crazy blow off high, right? And when it let go, it literally fell through. So the way I use this chart is this is a 60-minute chart. As long as you're above the Keltner channel, you're in pretty good shape. So that looks very good. Then we fell below the Keltner channel and we stayed below it. And now all of a sudden we've been rallying above it. And we're sitting right at the bottom of the range. We've just broken the uptrend. We've broken the uptrend in momentum, which I don't really like. And you can see over here, we had an uptrend in momentum here, and when that broke, that was a pretty good clue. Well, we just broke, and we're sitting right here on zero, and it ends the day on Friday looking like it wants to wind down. Now, the problem with Friday was it was options expiration day, and when we go and look at the volume, let's just look at, I'm going to change this to SPY just to get a volume. What did I do? Dollar SPY. Yeah, that's not going to work. Okay. So what we see here is we had volume on this particular one. And when you look on the weekly charts, it was pretty muted. It wasn't anything really special. But in this case, this is what we would call, lost my train of thought. There were distribution day, where we have increased volume on a down day. Now, the down day wasn't very much, right? We were down we were flat. So usually we wouldn't count that as a distribution day. And every one of these other days, we didn't have a higher volume than the day before. So none of these look like distribution days, but to me, it looks like distribution when each day you're basically struggling to get higher and somebody's trying to sell into this rally as we get to the prior highs. We're doing a lot of trading, but we're not making any money. Everything's just sitting here. So want to be aware of that. Now, when I go look at the bullish percent indexes, this is what got me so bullish last week, was that a reading above 90 is a massive bullish clue. And when we look back at my charts here, back in 2003, 2004, that was the start of an epic rally that went on for another 9 months. When we look at 09 coming out of the hole, we got up here to this 90% level and we stayed up here for another 6 or 9 months. So that was pretty bullish. 2011, we were up here. 2013 and 14, that was that whole Fed QE, where unlimited money for friends and bonds. Everybody got money, so the market kept rallying. The risk level was minimal for hedge funds, and so they just said, hey, the Fed's got our back, we're going forward. And so everybody was very bullish, and the market just made that nice smooth rally all the way up. In 2017, we got up here, and we stayed up here for 3 months or so, and the market was very smooth in here, and we kept going. And again, the market doesn't really break until you start to make a lot lower level of stocks having above their 200-day moving average. So again, what happens is your whole market's thrusting higher, and then at the top, what happens is some names start to fall off the list, and as they're falling down, that's what eventually brings the market down. So here we have one of the highest readings ever. And so that looks pretty darn bullish to me, and very difficult for me to get too bearish too quickly when I have that kind of a result. Now, again, we were at 77 and we went to 92. So 15% of these stocks changed in 2 weeks coming off the lows. That tells me they're not very far from their 200-day moving average, but nonetheless very bullish. And then this week we dropped 6% already, even though we closed higher on the week. So a few names started to fall out. But what I don't want to see here is that all of a sudden, we give up that 15% again next week and we go down very, very quickly. Back in 2012, we started to have that sort of price action, and then the Fed had to come back in and support the market. We ended up with this choppy kind of period where we were just oscillating and not really going anywhere. All of this suggests to me that the market's very, very bullish. Now, when I look at the percentage of stocks rising this week versus falling, it was muted. We had very few stocks up 10% or more. We had a couple hundred or 300 up over 5%, but we had 400 or 500 that were down 5%, and we had very few stocks down 10%. So the weighting was actually shifted from what the market did and what was going on underneath the surface. We had more stocks down 5% than up 5%, even though the markets moved higher. So this is the chart that makes me so bullish, because it's very rare to have, I'll call it a bear market when you're up here at 90%. It's really, really hard. Now, that doesn't mean that we can't have these kind of things like we had in early 2018. Remember, we kind of had that final thrust, and then we fell apart and we lost 20% in, a month. January to early or late February, we dropped a full 20%. Now, we just did that on the indexes, right? This is a 20% move back here for the NASDAQ. It was a pretty quick one. Dropped really hard and then rallied back up. So it is possible. It's not like we don't have those prior examples. We have that one in 2018. From 2017 high to that 2018 kind of climax blow off, we had that 2020, then we had, that September blow off, and yet we recovered so quickly from it. That's what gives me optimism that we just want to keep charging higher. All that to say, the market's pause this week was really uncomfortable in what the big tech names did. It looked like they were being sold off. Now, Looking at my Canadian market, which is near and dear to my heart, one of the things that we see on this particular chart, the green lines again are the current settings. One of the things we see is we're trying to get through the 2017 highs, 2018 highs, most of 2019, and then we had the brief surge at the end of the year, and now we're kind of stuck at that level again. The Dow Jones Industrial Average is doing that. We've got Germany's doing that. Japan is doing that. Lots of these charts are stalled at those kind of prior highs. So when I look at the Canadian market, one of the issues we've got is we're still making lower highs on our 200-day moving average. And so that's a little bit of a problem for us, as this is, it's the good news is we're still rising. The bad news is we're still not up above the 70% level, which is usually more of a bull market territory. So that would be something I want to see. When I look at my bullish percent energy index, this is just so frustrating. So what we see up here is West Texas crude is holding above the 20-day moving average. The bullish percent index has started to rise again, and we're starting to get a little bit more enthusiasm, and we're moving above the 20% level. And again, just moving above that is a pretty good place to get on board. But what we saw here on XLE was it briefly tried to get above it last week and all this week and closed, as you can see over here, below it. We look at the XOP, and this is doing the same thing. It basically is having trouble staying above it. And then we look at the OIH, which is the oil services, and it really didn't have any sort of positive momentum. So we closed Friday on a high and then spent all week going lower. And again, we just can't get through this 20-day moving average. And what I want to see is all 5 of these do that. And so far we have 2. We have the bullish percent. We have West Texas crude. So that just says to me that energy tried to rally and is really struggling. Not good. Now, some people are optimistic on gold. I continue to be frustrated by gold because what we see here is gold up at the staying below its 50-day moving average. The bullish percent has been declining and is below its 50-day moving average. When we look at the gold miners, they're below their 50-day moving average. And we look at the gold mining ratio, it moved back and closed below the 50-day moving average again. And so when everything on this little list of mine is below the 50-day moving average, it's just a good place to be cautious at least. And what we see here is, we've been declining for 2 or 3 months and there's not a lot of positive momentum. So everybody expects the next week to be the turn for gold, but the bottom line is we continue to make lower highs and lower lows, and this week the gold chart did just that. Okay, so here's the options expiration page, and what this chart is every vertical line is the options expiration. And what happened in February was we basically rallied, made a slightly higher high, and then we fell apart literally on options expiration day, and then we just cascaded down very, very quickly. Now, are we doing that again? Who knows? More importantly, though, is that NASDAQ chart I just showed you had momentum sitting right at 0. The PPO, the 60-minute NASDAQ chart, had momentum right at 0. And we were starting to break through my Keltner band, rising again. So the NASDAQ is sitting there basically teetering on the edge of breaking down again. And I guess if I went back and got that chart and we go back and look at what happened in that February timeframe, we had the same sort of thing. We had a January high. Let's just lift this up here. We had a January high, and then on that January high, actually, I'll do this differently. I'll move this up and this down. On the January high, we rallied up, then we pulled back briefly, and on this rally, we had a lot less momentum. Okay, it was roughly a month apart, and then it all fell apart. So we had our big push up into early September. We pulled down. Now we've made a lower high so far. We're losing momentum. And if we start to break down here, that would be a concern. Now, the other thing to remember is it was October 9th, 2009, just to pick an ominous period where the market had a lot of euphoria. We'd broken above a July high. We kept trying to break out. And in early October, basically, the market just failed to rally anymore. The S&P topped out in October. The NASDAQ topped out in November, and it basically was a wide broadening top. October can mark really good lows like it did last year. It was basically October 2nd was the low, and we rallied all the way to February in that case. So it was a really strong place. But the one thing that I like to point out with the options expiration day is sometimes we just go through them very smoothly and it's a really, no big deal event. Other times it can actually mark the critical top or the critical bottom, and they're worth paying attention to. So, and the reason is because a whole bunch of people can put options on to go the other way. As soon as that first options expiration expires, now they've got a whole month to work with, or it could be a quarterly option or whatever they want to work through. Down here, this quarterly options expiration pretty much marked the low. We made a slightly lower low on the Monday, and then after that, we didn't, that was the low, and then we went on to make higher highs through there. So the last one was an important event. Now here we're sitting slightly below a lower high. We just want to make sure, and we had the same thing back here where the market started to weaken during that week. So we gapped up on the Monday, pulled back. And again, I don't feel like we're ready to go down here, but the price action in all of the big names was not wonderful. Okay, so let me just check one more thing here. Okay, so working through the different charts that I saw this week, here's the monthly performance, and we have a Fed meeting coming up in 2 weeks, so that might help. It comes up right after the election. Here's the uptrend that we kind of started back here on September 23rd, and we kind of rose up, and now, you can see if we drew a line, we broke through that, no big deal. When we go through looking on the year-to-date chart, this is probably, you don't always have to use the spike low, and if I continued this one back, it would come very close to this point. But I would just say that, here's what we're looking at for an uptrend, and this was the previous February high on this red line. So if we're going to break above here, this is measured in percent from the beginning of the year. So we were up at one point on the S&P up 11%, pulled back down to the zero line. I think anybody who's a subscriber kind of had that area on their radar, and sure enough, we bounced right off the zero level and came out of here. Now the real question is, do we have the momentum to go through? And what we don't want to see, obviously, is that this starts to break down basically through that February high again, because that would be a failed breakout. And then if we start to break the uptrend, then obviously that gets a little more ominous. And can we find support at the beginning of the year level? So those would be the three different reasons to pay attention. So far we're stuck below the prior high, and what we want to make sure is that we can turn and accelerate out of here. So we've got tech earnings coming up over the next 10 days. Those ones should help us a little bit more, but quite frankly, the fact that we had zero rally on all of the financials doing great was very concerning to me. Okay, I just need to think. Okay, so one of the other areas that I like to go through are the transports, and I don't want to say I'm Mr. Trucker, but I worked for Shell selling fuel to truckers for many years, and my initials are gas, and so I'm kind of in the fuel business and the trucking business. I sold refrigeration systems for Thermo King to the truckers, so I'm a little bit into the truckers. What we see here is this big giant uptrend that we've got going on. And again, we broke through prior highs, very bullish, and we got up here. We want to see this uptrend continue. Now, the next chart that we get into is the weekly, but what we see here again is we're making lower highs on momentum. And again, if we started to roll over here, that would be concerning. Volume is a little bit light as we're making this rally. So this week we didn't do anything. We basically jogged sideways on transports. Can't throw it out because we jogged sideways. The big thing here is we had a 2-year trend line going on that we broke above, and then we stalled immediately. So we want to make sure that this doesn't become one of those where you run up, you have a doji, and then you fall apart, and that would be a concern. So let's just put the candlesticks on here, or the high-low close is what I just think it's a little cleaner. So we immediately break out, and then the first thing we do is stall. So this is not preferable. It's like a plane taking off and then we stall. It's really not kind of the price action you want to see, and we don't want to see that start to return back down. Now, two things are in play right here, right now. Obviously, it would only be a 1 week to get back to this horizontal support, but we don't want to break the uptrend that we've had going off the lows. This line, I could probably massage it a little bit and move it up to touch the bottom of here. Let's just leave it in place. I've had it sitting here based on the line chart that I just showed you. So we'll leave it in place. But I think more importantly that what we want to pay attention to here is how does this price action work over the next 2 weeks? So that the transports are a concern. Okay, so here's the big picture. For airlines, and as you can see, Warren Buffett sold half his airline stocks here, and I think he sold the rest right here. They've basically migrated and done nothing since, so it's not like he made a bad decision to sell down here. It's just they haven't had any mojo to the upside either. So it's a little hard to get very excited about that. That's the 60-minute chart of the airlines, and you can see they're trying to hold this horizontal support. They're laying off people, and look at their downtrend in momentum here. If this can start to improve, that might give us a clue that things are going to turn up. That hasn't happened yet. Somebody left their microphone on. Let me just mute that. Okay, and then what we see here is this big uptrend going on. Like, it looks bullish to me, right? You're right up against this uptrend now. When I go to the weekly chart, one of the things, so just maybe to conclude a little bit here, as we go down to the right here, what we don't want to see is momentum fail again. We're near that 2% level, and we just don't want to see it go below zero. Railroads are a really good leading example. Recently, we broke down below this uptrend line, so that was concerning, and we bounced out of here Thursday, Friday. So maybe that's okay. But here's the weekly chart. Can this get any finer tuned? So we have an uptrend that we're trying to hold. We have kind of the overall trend rate for airlines rising, and we're right up near the top of it. The problem we've got is this uptrend in momentum is starting to break. And again, you know, when the railroads break, that's a pretty good place to pay attention to. And in 2019, you know, just when these uptrends broke, basically the market did nothing for a while, and whatever, 5-6 months, no big deal. What I think is more concerning, obviously, is if all of a sudden, you know, the global economy can't get going, then this would be where we'd start to see a slowdown. So I don't want to overreact to it, but I would just say we're right at the decision point for this particular chart. Here's trucking, and the concern I have in the trucking business is this uptrend that we've had going since the beginning of the rally has now broken in terms of relative strength compared to the S&P 500. When we look at trucking compared to its peer group, it was outperforming. It's now starting to underperform, and that's just a bit of a clue. Now, we're not just talking about Friday. We're talking that for the last month, the scooter ranking for this particular industry group has been weaker. So we've pulled back down. We came back up. What do? We test the prior high. And I would pretty much say on Friday, that was like a failed test result. Now, that was the kind of breakdown we started to see in February where things just started to fall away. That's not the right comparison because we don't have that much weakness yet. We got so many stocks above their 200-day moving average. Things look pretty good. The real question here is, what is slowing down trucking all of a sudden? And there's a Navistar deal out there, and there's I think, I'm trying to remember who it was. One of the companies announced the sales of tractors, power units, as we call them. So the trucks that pull all the trailers, they were up 61%. That's a pretty strong number. So to me, that indicates that the trucking area is still pretty good. But again, we have this problem where we have this wave where we came down below zero, rallying back up and are now putting in a relatively weak response. I don't want to see that. So back here you can see we rallied up, kind of failed, pulled back down, and then tried to rally again for a couple of weeks, and then we fell apart. We're making lower highs and lower lows in momentum, so it's at least cautionary. Now, when we go to the weekly chart for the truckers, You can just see this double top system. We've already had a PPO rollover. That's not really good. And then what happened for the truckers the last couple of years is they migrated sideways. So even as the PPO was up high, it was declining. They didn't actually decline, they just stayed in line. So maybe that's where we're going with the truckers. We just end up in line and they trade sideways now. They've had their kind of growth spurt and we seem to stall here. But seems like an odd time considering everybody's trying to move everything to retail and that ends up using a lot of trucking. Okay. I've got a couple of minutes for questions, so if you wanted to type those in, great. And I'm going to quickly look at this auto chart. And the reason I want to look at it is because Tesla is a big part of this. Pretty much this whole thing is Tesla. And what we see is we're sitting up here right at the top. And one of the concerns, as I mentioned earlier, is Tesla is starting to get a little questionable, but other automakers are starting to improve. And again, you can see that on that ChartWatchers article. But here, we've got momentum starting to roll over here. So momentum rolling over here, momentum rolling over in trucking, hasn't rolled over in the rails yet, and the airlines are clearly muted. So between all of those things, the transports are starting to add some caution. I would just leave it that way. Okay, I'm just going to quickly look at the two questions we've got, and then I'm going to flip it over. Okay, so can I please look at the Canadian dollar? Yes. And one of the concerns I have around the whole gold thing is that the Canadian peso is not doing that well. We had a tough week on Friday. Oops, Japanese yen. So here's our Canadian dollar, and we're trying to get through 77, and this is pretty important. This is our weekly bar. Basically, we stalled at 76 and we pulled back. Now, going over here, again, the Canadian dollar looks a lot like the oil chart typically. If we map the two together, they map okay. What I don't like here is, again, our PPO rolled over below zero, is rallying back up and seems to be stalling here. We're trying to get back through the 77 level. We haven't been able to do that. And looking at this horizontal resistance at 75.50, it looks to me like this is, losing its momentum. Now, Friday was okay, but Thursday was awfully weak. And the US dollar in general looks like it wants to go higher. I've got that on one more chart over here. And I want to be very cautious on running over on time so that we get all of Andrew's stuff here. We have horizontal support sitting right here. If the US dollar is going to start turning up, look at what my PPO is signaling this week. It's not really what I wanted to see, was US dollar momentum wave starting to improve. And even if it's only for a couple of months, we're sitting right at support. So it's a pretty concerning place to just say no big deal. Actually, if it was to go all the way back to the top of the range, that would be a big deal, and we'd probably find that all of the emerging market data broke down. And when we go look at the emerging market currencies, which is commodity currencies, it had a mellow week, but look at this trend here. What I was hoping was we would break out to the upside and all of a sudden commodities would be in this resurgent mode and we would get this big push globally where things could start to improve. And if that was going to happen, that would really help the whole commodity front. We continue to waffle. We just can't seem to break out. And so it spent most of the week going lower. Now we're sitting right down at zero. Can we rally out of here and restart the rally? Good question. But if we don't, commodity holders, be very aware, because that's your gold, your silver, your copper. And I didn't cover copper, but oil. If commodities don't get rolling, then the global economy is stalling, and that's a bigger deal. Now, Shanghai put in a good week, so I like that. Australia made new highs this week, made higher highs this week, and closed up at the top. So that's good news. In general, it was a big week of pause, but the problem is where we paused. We paused right near the top of the market, and we just don't want to see things start to unwind from here. This is the EEM, the emerging market ETF, and as you can see, we tried to break out, and we basically got up and pulled back, and now we're just stuck here. So I'm bullish because we were breaking out. Now I'm hoping it's just a pullback to support, and off we go. It's really important that the rest of the world economy gets going, because the technology names can go for a while by themselves, but we kind of need the whole picture, the whole economy to start accelerating. And so far, my charts were less than enthusiastic about that. Okay, so with that, I am going to um, transfer everything over to Andrew and have him work through it.